What if I told you that the greatest trader in human history didn't work on Wall Street, never had a single losing year in 3 decades, and once made a cool $1 billion in a single afternoon? Most people think making billions in the stock market requires a massive algorithm, a supercomputer, or inside information. But in 1992, one man proved everyone wrong by executing a single trade so devastatingly accurate, it literally broke the Bank of England. His name is Stanley Druckenmiller. And if you are still relying on traditional, slow, boring diversification to build your wealth, what he did is going to completely shatter everything you think you know about money. Imagine standing on the edge of a cliff. Below you is a safety net, but it is thin. In front of you is a lever. If you pull it and you are right, you become a billionaire. If you are wrong, you lose everything. Most people would walk away. They would play it safe. They would put their money into an index fund and wait 40 years. But Stanley Druckenmiller looked at that lever, looked at the risk, and did something that made even the legendary billionaire George Soros gasp. He didn't just pull the lever, he pushed every single chip he had down to his last dollar right into the center of the table. This is not your average rags to riches story. This is a masterclass in psychological warfare, extreme risk management, and the terrifying art of betting it all when you know you are right. This is the story of how Stanley Druckenmiller turned a modest beginning into a personal net worth of over $6 billion, all while navigating the most volatile financial markets the world has ever seen. To truly understand how a human being can operate at this level without snapping under the pressure, you have to go back to the very beginning. Druckenmiller didn't start with a trust fund. He wasn't born into a banking dynasty. In the late 1970s, he was just another young, ambitious guy working as an equity analyst at Pittsburgh National Bank. He was smart, sure, but Wall Street is full of smart people. What set him apart immediately was his radical, almost frightening ability to see through the noise of the present and predict the chaotic reality of the future. The bank quickly realized they had a prodigy on their hands. Within just 1 year, at the absurdly young age of 25, Druckenmiller was promoted to head of the entire equity research department. Think about that for a second. You have veteran market analysts who have been studying charts for decades, and they are suddenly reporting to a 25-year-old kid who hasn't even seen a full market cycle yet. How did he do it? It all came down to a fundamental truth that most retail traders still don't understand today. Druckenmiller realized very early on that the current earnings of a company do not move its stock price. Let me repeat that because it is the #1 mistake amateur investors make. Corporate earnings do not move stock prices. What moves stock prices is a massive change in the future economic environment that people don't see coming yet. He wasn't looking at what a company did yesterday. He was looking at what the Federal Reserve was going to do 3 months from now. He was looking at liquidity. He was looking at the flow of money. By 1981, Druckenmiller decided he was done making millions for a traditional bank that paid him a standard salary. He wanted a piece of the real action. He launched his own fund, Duquesne Capital Management, with just $1 million in assets under management. It was a boutique fund, but his returns were so spectacular, so consistently ahead of the market, that word began to spread through the elite circles of global finance. And that is when the ultimate phone call came. George Soros, the undisputed titan of the hedge fund world, the man running the quantum fund, was watching this young kid from Pittsburgh. Soros didn't just want to invest with him, he wanted him to be his right-hand man. In 1988, George Soros hired Stanley Druckenmiller to be the lead portfolio manager of the quantum fund. It was the ultimate pairing of financial minds. Soros was the philosophical, big-picture visionary. Druckenmiller was the tactical genius, the sniper who knew exactly when to pull the trigger. For the next 12 years, this duo went on a historic run that will likely never be repeated. They didn't just beat the market, they crushed it, they dominated it. They averaged annual returns of over 30%, and they did it by trading everything: currencies, bonds, commodities, global equities. If it had a price ticker, they were trading it. But everything they did, every single trade they ever made, was just a prelude to the year 1992. This was the year that would define Stanley Druckenmiller's legacy forever. This was the year of Black Wednesday. To understand the sheer scale of what happened, you have to understand the European Exchange Rate Management, or ERM. Back then, European countries were trying to peg their currencies to each other to create stability before the introduction of the euro. The British pound was locked into this system, meaning the British government was legally obligated to keep the value of the pound artificially high, tracking closely with the German Deutschmark. But there was a massive, fundamental problem. Germany had just reunited, and its economy was booming, causing high inflation. To fight inflation, the German central bank raised interest rates sky high. Meanwhile, Great Britain was slipping into a brutal recession. Unemployment was skyrocketing, housing markets were collapsing. Normally, when a country is in a recession, the government lowers interest rates to stimulate the economy. But because of the ERM peg, Britain couldn't lower its interest rates. If they did, capital would flee the pound to chase the high interest rates in Germany, and the pound would crash. So, the British government was trapped in a nightmare scenario. They had to keep interest rates painfully high just to support their currency, even though those high interest rates were actively destroying their own domestic economy and suffocating their citizens. Stanley Druckenmiller looked at this macroeconomic puzzle, and he didn't just see data points, he saw a historic structural flaw. He realized that the British government was playing a massive game of poker, and they were bluffing with an empty hand. They could not hold this peg forever. Economically, it was unsustainable. Politically, it was suicide. Druckenmiller went into Soros's office. He explained the situation. He told Soros that they needed to start selling the British pound short. He suggested they build up a massive short position of about $1.5 billion. It was a huge, incredibly ballsy bet. If the British government managed to defend the pound, the Quantum Fund would lose hundreds of millions of dollars. Soros sat there, listened to the young trader, and looked at him with an expression that was half amusement and half pure predatory instinct. Soros didn't tell him to be careful. He didn't tell him to manage his risk. Instead, Soros looked at him and said something that changed Druckenmiller's life forever. Soros said, "That is the most ridiculous thing I have ever heard. If you know you are right, why are you only betting $1.5 billion? Go for the jugular." Think about the psychological shift that occurs when a legendary billionaire tells you that your massive, terrifying bet is actually too small. Soros taught Druckenmiller the ultimate rule of elite trading. It doesn't matter how often you are right or wrong in the markets. What matters is how much money you make when you are right and how little you lose when you are wrong. Most traders spend their entire lives trying to be right 80% of the time, making small, comfortable profits. The elite traders don't care about being right all the time. They're fine being right only 40% of the time, but when they hit that 40%, they size their bet so massively that it wipes out all their small losses and creates generational wealth in a single move. Druckenmiller got the green light. He went back to his desk, dialed his brokers, and started shorting the British pound with an aggressiveness that the financial world had never seen before. He didn't just bet $1.5 billion. He didn't just bet $5 billion. He built a short position worth an unbelievable $10 billion. Think about the sheer, staggering weight of that position. A private hedge fund was using massive leverage to short $10 billion worth of a sovereign nation's currency. They were essentially declaring financial war on the British Empire. As the days went on, the pressure on the British pound became unbearable. On September 16, 1992, the crisis hit its absolute boiling point. The Bank of England woke up to a massive coordinated selling panic. Everyone was dumping pounds, led by the massive momentum generated by Druckenmiller and Soros. The British government panicked. In a desperate attempt to defend their currency and buy back their own pounds, the Bank of England bought billions of pounds in the open market. It didn't work. The selling pressure was too immense. Then, in a move of pure desperation, at 11 a.m., The Bank of England announced they were raising interest rates from 10% to 12%. Imagine that, raising interest rates by 2 full percentage points in a single morning during a recession just to stop the bleeding. Amateur short sellers would have panicked right there. They would have seen the interest rate hike, gotten scared of the government's power, and closed out their short positions to lock in a small profit. But Druckenmiller didn't blink. He knew the British government was bleeding out on the floor. He knew this interest rate hike was a sign of total weakness, not strength. It was an act of pure, unadulterated panic. He didn't cover his shorts, he held his ground. The markets saw right through the bluff too. The selling continued. A few hours later, the British government, completely out of options, announced yet another interest rate hike.